day the cashier informed to the accountant, okay, record this. So then we have a printed paper or something, and then accountant records the entry. So that chances of fraud or this kind of stuff is going to be minimized to the, you know, to the, arm's length, or you can say that whatsoever control is that, to the maximum control you have. So big bookkeepers should not handle the cash. That is the duty of teller, bank teller, or banks, or your cashiers. So he's only recording the amount. That's it. So separate employees should open incoming mails and make deposits, right? There's a lockbox system. So if your customer is sending you cash through mail, so that person who is handling those boxes in which mail is coming, that person is different, and that who is recording it has a different rules. Okay. So these are the guidelines. So those who are watching online, so please pause the video and read it by yourself. So these are some issues and plan of actions if what we do and what are the benefits of handling these account receivables separately. Okay, here let's go towards the numerical side of accounting. Evaluate collectibility using allowance for uncollectible accounts. Now the idea behind is that because business, in any business, planning is the foremost important issue in any kind of business. If you don't plan or forecast your cash flows, then in future you may be having some severe problem of liquidity or cash, because on daily routine basis, water charges, daily wages, those who are working daily wages, you need to pay them, and customers, care charges or repair and maintenance of vehicles and all the stuff, anything can happen. So you are maintaining penny cash as well, plus you need to pay at the end of the month your employee salary, payment to the suppliers, all those stuff, right? Payment of the rent, taxes, commission to your salespersons, right? So if you are not planning your cash flows, then you may be having a severe cash issues or liquidity issues, which may leads to your destruction of the business, or people going out from your business, canceling your contract with you because you are great business but you don't have cash. So that's why we call this cash is part of any organization. So smart managers, right? Smart managers, they plan in advance. Plan for cash inflow and cash outflow, right? So mainly cash is inflow. The major part of cash inflow is coming from all right. So if you are not planning this carefully, then all the cash outflows is going to be disturbed, right? So in order to plan the cash inflows, the managers also include some kind of chances that, okay, if customer need to pay us $1 million, maybe 3% is bad customers. We will be having collectibility issues. So rather just basing that, okay, in 3 months we will be receiving 1 million, they will say that no, we will be receiving $970,000. So they include this 3% of chances that their customers may be bankrupted or they are not paying that. So that their cash inflows predictable, and they can easily manage their business activities. So for that 3%, rather just wait for 90 days and then find out that 3% are bad debts, are your bad debtors, are your bad customers that they are not paying you. So rather you include in your planning in advance so that your planning is not disturbed. You are according to the plan. Your business activities are not hurt by cash disbursement. So the idea is that you make allowance for uncollectible accounts. So part of account receivables that you think that is not going to be received, right? So you plan in advance and you charge at the initiation of the account receivable. You plan and you charge some amount to account receivable so that our cash is not disturbed. So earlier we made cash budget, right? So that our cash budget is not disturbed. Our monthly cash budget, okay, January, February, March, April, we have to pay, pay to the suppliers, salaries, dividend, buying some, business holds item, carpet, furniture, machinery, plants, vehicles, so that our cash planning is not disturbed. So smart managers, they do include some kind of, they do plan in advance that in future some of the account receivables will not be received. So guys, you understand the theory behind or the logic behind allowance for account receivable? All right, David, Faik,
Yeah.
Suzanne,
It's
Vaneshi.
all clear, sir.
Good. Okay, now let's deep dive into the understanding of allowance for uncollectible. So normally account receivables occurred when you are selling on credit. Of course, when cash is received, then there is no account receivable and there is no uncollectible. But there is a benefit of credit because most businesses use credit as a norm, as a tradition of doing business. Plus, it customers can buy on credit. It increases your sales and profits. So your balance sheet and your income statement looks good. Then the cost is that company cannot collect from some customers. Not every finger is the same, right? Not every customer is the same. So company record as uncollectible account expense when happened. So rather to wait till the end and find out that, okay, this customer is not paying us after 3 months, 4 months, and you also have a lawsuit and all those stuff, and you wasted your 8 months. And then you realize this customer cannot pay us. So you charge it to expense. So you make a smart move in advance, you plan for uncollectible. All right. So you record, you use allowance method, or you make a reserve. In some books, it is called reserve. You make uncollectible reserve or allowance. So you record collection losses based on company's collection experience. So if you have a history, okay, whenever we have a credit sale of 100,000, so 1%, normally we see that 1% customers are bad, they don't pay us. So you in advance from your history use 1% to the new sales and include in your planning. So you record uncollectible account expense in the income statement. So anything that is uncollectible charges to expenses and expenses go to income statement. So you set up allowance for uncollectible account, for example, allowance for uncollectible account, and that would be a contra account like depreciation account, which is contra account of assets. So we write down equipment minus accumulated depreciation. So similarly, these are written on the asset side, but as a contra account, account receivable minus allowance for uncollectible account. Simple. So this is a contra account, which means amount of receivable business expects that it's not going to be collected. All right. So how we write down on balance sheet? So there is a partial balance sheet which shows only the current assets. So don't get confused by this partial word. So this is not the complete balance sheet. This is just a current asset side of the balance sheet. So we have cash, we have account receivable 500, and in advance they have maintained allowance for uncollectible debts at 25, so that they're planning their total assets and their cash budget is not disturbed. All right. So in a sense, they are saying that chances are that they're going to be 25 out of 500 is not going to be received. So your total account receivable is 475. All right. And then you write down inventory, prepaid, and total current assets. So what we learned is that allowance for uncollectible account is contra account of account receivable. So there are two methods. One method is you write down less account receivable and uncollectible as this format. You can also write down as account receivable net of 25 allowance, 475. It means 475 plus 25 is your original account receivable, less 25 is your allowance for uncollectible. So that's why your account receivable is 475. So in some books, you will find out the balance sheet is written like this, and in other books you find out that it is written like this. So it's up to you whether you want to follow this method or this method. Both are acceptable in accounting world. Now, methods of estimating the uncollectible, because the uncollectible didn't happen yet, you are planning for. So we estimate, we predict, we forecast how much account receivables are not going to be collected.